You know, when we think of farming, we probably picture tractors in a field. But in 2025, the real action isn't just about the steel anymore. It's all happening in the software. The agricultural machinery industry has, believe it or not, become a high-stakes tech arms race, where data is the new ammunition. So let's dive in.
This quote from HDIN Research, while it really gets to the heart of the matter, the industry is in the middle of a massive paradigm shift. It's moving away from just pure hardware, mechanical engineering, and toward these complex, intelligent ecosystems. This transition, right here, is the central theme of our entire explainer. All right, here's how we're going to break this down. First, we'll look at the challenging market conditions that are really setting the stage for all this change. Then, we'll get into the two competing philosophies driving the industry. After that, we'll cover the traditional, but still absolutely critical, power of brands. Fourth, we're going to dissect that all-important pivot to software. And finally, we'll give you an outlook on who's really best positioned for the future. Okay, so to really get why this tech race is happening right now, we have to look at the pretty tough economic environment of the 2025 fiscal year. It's a time with some significant headwinds, and it's forcing every single company to completely rethink its strategy. Honestly, it's a perfect storm for farmers and manufacturers alike. You've got high interest rates, low crop prices, and a huge backlog of used equipment all hitting at the same time. And the result? A steep 15 to 20% drop in large equipment sales in the absolutely critical North American market. That forces a major strategic rethink. So here's the crucial point. When you can't compete by just selling more and more machines, you have to find a different way to compete. This downturn is actually accelerating that pivot. Companies are now racing to build these deep, defensible moats around their technology, really trying to lock in customers for the long term. And that race has created this absolutely fascinating strategic divide. We're seeing two very distinct philosophies emerge for how to win the future of farming, and they're both playing out on the same global battlefield. So on one side, you've got the digital leaders, think Deere, CNH, and AGCO. They're betting everything on creating these integrated, full-stack tech solutions. We're talking hardware, software, and data, all working seamlessly in one ecosystem. Then, on the other side, you have the engineering reliable purists, like Class and Butcher. Their focus is still on achieving the absolute peak of mechanical performance and just bomb-proof physical reliability. And the kind of financial firepower you need for that digital strategy, it's immense. Deere is spending a staggering $2.3 billion on R&D. CNH is over $1 billion. Now compare that to a value-focused player like TYM at just under $16 million. This isn't just a strategic choice, it's an incredibly expensive all-in bet on who's going to own the future of the farm. But hey, don't count out the engineering camp just yet. This number, it perfectly illustrates their value proposition. The Class Jaguar 1000 harvester can process 500 tons of forage an hour. That is a world record. It's a tangible, awe-inspiring feat of pure mechanical engineering that provides incredible value to a certain type of customer, one who prioritizes that raw performance above everything else.
But, this whole tech race doesn't exist in a vacuum. It's built on top of the traditional and still hugely important moats in this industry, brand power and physical reach. Let's take a look at how they're still shaping this battlefield. This table tells such a powerful story about pricing power. I mean, look at the top. Toro's specialized dominance lets them command a massive 33.4% gross margin, with Deere not far behind. This just shows how a trusted brand lets you charge a premium, which is crucial for protecting profits in a downturn. And you'll notice CNH at the bottom, that lower margin, it highlights a real vulnerability for them. Now, another critical moat is reach. This number, 2,050, represents Deere's dealer points in North America alone. Think about it. When a combine breaks down during that critical harvest window, uptime is everything. Having a dealer within a reasonable service radius is totally non-negotiable for farmers, and that creates an incredibly powerful and hard-to-replicate advantage for the incumbents. And that service network, it creates another huge benefit: parts. An incredible 19% of AGCO's total sales come from just replacement parts. This is a highly stable, high-margin revenue stream that provides this crucial financial cushion, especially during cyclical downturns when new equipment sales are slow. It really is the gift that just keeps on giving. So, this brings us right to the core of the industry's transformation. The ultimate goal of these digital leaders isn't just to sell you a smarter tractor. It's to change the entire business model from one-time hardware sales to recurring subscription revenue. So let's be really clear on what this actually means. Solutions as a service, or SaaS,
is all about selling an outcome. So instead of just buying a sprayer, you might subscribe to a service that guarantees a certain level of weed reduction with maximum chemical efficiency, all managed through software and data coming from the machine.
Deere has the clearest strategy here for sure. It's a classic three-step process. First, sell the smart hardware. Second, get that hardware connected to their proprietary John Deere Operations Center platform. And third, once the customer is locked into that digital ecosystem, you drive that recurring, high-margin revenue through software subscriptions for advanced features. It's a classic walled garden approach.
But AGCO is launching a direct counterattack. Through their PTX Trimble venture, they're going after an open, brand-agnostic strategy. Their goal is to sell retrofit kits that can upgrade any machine, whether it's a Deere, a CNH, or something else entirely, with their precision tech. They're not trying to build a walled garden, they're trying to become the operating system for the entire industry's mixed fleet. But you have to understand this pivot comes with immense risk. This number, $172 million, is a non-cash impairment charge that CNH had to take on its technology acquisitions in 2025. It's a stark reminder from the balance sheet that betting on tech is incredibly expensive, and if the payoff doesn't happen as planned, well, the financial write-downs can be absolutely brutal. This is a very high-stakes game.
So after looking at the market, the players, and all these strategies, what's the outlook? How do we put all this together to understand who is actually set up to harvest the future?
Let's just ask the question directly. With everything we've seen from the 2025 fiscal year, who is really in the strongest position to win this ag tech arms race and deliver value for years and years to come? And here it is. This is the single most important takeaway. For decades, success in this industry was defined by your service radius, your physical dealer network. But the winner of tomorrow, the winner of 2026 and beyond, will be the company that can convert that physical proximity into digital stickiness. It's all about leveraging that existing trust and infrastructure to lock customers into a software ecosystem they simply can't live without. That transformation, that is the key to the future of farming.